Hey, we all know it's wonderful being human, but as humans, we tend to make very predictable errors. And with the bull run we've been on, we're seeing people make the same errors they've made every time that we've been on a long bull run. We're going to get into that right now. Active versus passive portfolio errors.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
We've been on a strong bull run for quite some time now, and we're seeing investors making the same mistakes they make every time there's a long bull run. And by the way, they make a different set of mistakes every time there's long bear runs. So it's the fact that we as humans are emotional beings, and we tend to react in ways we probably shouldn't, and they're generally against our best interest, especially when it comes to managing money. So there is a long holding debate about active versus passive, and there are portfolio errors that are made when people are looking at that. And I call this time when these things happen, the active versus passive portfolio errors. Now, there is also something you need to keep in mind in terms of risk management. We're going to talk about that in just a moment because risk management fits in at both the active and the passive levels. Now, today we're also going to go back and look at market data and what's kind of going on overall, as we always do. That data ends as of last Friday, which was March 8th. So with that being said, let's jump right in. Now, oftentimes I'll have multiple different visuals for you. Today I'm focusing on one single visual. It's rather simple, but it's unbelievably powerful. And as the top of it says, it is the idea of active versus passive portfolio management. And these stats were pulled together by Sorelli and Associates looking at Morningstar Direct data. So here they're trying to identify, it doesn't matter if it's a mutual fund or if it's an ETF, it's a mutual fund or if it's an ETF, they're looking at the overall active versus passive categories and the total number of assets. Now, this is in millions of dollars here. So in other words, this number would be 13 million millions. That's probably the easiest way to say it because it becomes such a large number. Now, this is all of the total active versus all of the total passive. And look at right here, 13 million millions, and almost identical down here, 13 million millions. This is as of December 31 of 2023. So active and passive are almost identical. I mean, literally, you can't hardly get any close. When you're talking about numbers that big, you can't hardly get any closer than that. And they are literally neck and neck. But look what happened in 2023. In 2023, the active had an outflow of negative 450 million millions, thousand millions. It gets confusing, right? 450,000 millions versus 528,000 millions going into passives. So a tremendous, one was just as much positive as the other one was negative. So there's this swing that's taking place, and this is so predictable. Because when the bull is running, when the market is performing, people look at their active management and they're like, well, why would I do that? I can just hang on to the passive stuff and it's doing just as good or maybe even better. Because sometimes that passive stuff is literally outperforming what the active managers are doing. But you have to understand that when that is not the case, all of those dynamics can change. Because when the market is in a bear environment, that active management might have sidestepped you out of equities and saved you just a boatload of money because it can actively be changed, where passive management cannot be changed. In fact, there really is no management. They shouldn't even call it management. It's just passive investing. It's active management, passive investing. So the passive, there's nothing to be done. It just mimics something. Mimics the S&P 500, mimics the NASDAQ 100, mimics some other subset of the market and just will kind of coast along doing whatever it does. Active management, on the other hand, means there's either a human or a formula of some sort driving changes and decisions inside of that portfolio. I tend to like a couple of different things. When I'm looking in this environment, I like things that get out of human emotion. So I like formulaic type approaches to things. And again, as I mentioned earlier, I really, for my own personal money anyway, I can tell you, I enjoy risk management. So whether that risk management is applied to some passive holdings or some active holdings, I like the idea of risk management, meaning it can trigger a change when big shifts occur, because they say shifts happen. So when shifts happen, I want risk management in play to help protect me from, again, that lost decade or things of that sort. So these are conversations to have with your financial advisor. Don't just have a knee-jerk reaction like you're seeing most of the do-it-yourself investing public taking place here, which is what drives a lot of these numbers. Not all of them, obviously, but drives a lot of those numbers, is people just kind of, they knee-jerk react out of passive. Maybe they're trying to save some fees because, generally speaking, passive investments are cheaper to operate, so they have lower fees. Active investments take activity, so they cost more to operate and they have higher fees. But there's an offset for all of that. So think that through, because right now, just seeing this discrepancy here, the way we see that swing between those two numbers, it's telling us that people are making decisions likely for the wrong reasons right now because we've been in a bull market in 2023. So with that being said, let's look at what else is going on in the market. So as always, we're talking about capitalization. We're looking at a 1-year chart here. We're taking all of the capitalized subsets. So we're going from large cap down to small cap. And then right here, this blue bar, we're taking the Vanguard total stock market to kind of take an overall average view of what's going on. And what's really unique is look at how high this is ranking up here. It's the second in line right after the S&P 500. Normally, you're going to see that thing coming in somewhere around in this area, down in the middle of the pack, because normally, like, large cap will be on one side, small cap will be on the other side or whatever, and it kind of balances out. But because the large caps are performing so well as of late, and because there is weighting in this, and you do see that the overall stock market is more heavily weighted toward large caps, this total stock market is literally right up here at the top with the S&P 500. Here's the NASDAQ 100. Here's the S&P 100, the largest 100 out of the S&P 500. So the large cap is really driving what's going on in the market, kind of lifting it up from a bullish standpoint. When I say bullish, you can tell that it's bullish based on all these green dots, both the trend down here and the swing. These dots up here, they're both showing green almost across the board with one small exception here. And then down at the bottom, however, what you will see is the small caps and mid caps. The small cap 600s, whether it's the regular index, the growth, or the index or the value. And then the same thing here with the value, the mid cap, we got the value in the index down here at the bottom. We do have growth a little higher up here. But again, all of these, and actually right up to this one, right here, all of these are either small or mid cap, taking up basically the whole bottom half of the ranking, because we do rank this based on trend. And again, the trend is this down here at the bottom. So we've got all of this green in the lower right showing bullish trend. And we've got all these green dots here showing bullish on the swing as well. This is the 200-day moving average. And as you can see, the market's been on this long bull run rephrase that. It's been on a bull run for a number of months, but if we come back here for the full year, we've got the bull run coming up for the year quite nicely. Now, if we move on to sectors, again, there are 11 different sectors within the S&P 500, plus we add gold and silver in here as a sector for you to give an idea on that. Here we got the average weighting of all the sectors. Again, like I mentioned a moment ago, kind of coming in the middle, which is what we normally see. So that means those that are up here are kind of lifting the market up. Those that are down here are kind of bringing the average back down. But still, we're seeing a lot of green. That means we're tilting bullish in that sense across the board on both the trend and the swing. Again, all of this green down here taking place in the trend since late last year, and all of these green dots that we're seeing up in here showing that the swing is actually in the bullish category as well. Oh, and by the way, we've got information tech, industrials, and healthcare leading the charge versus real estate, silver, utilities, and energy down here on the bottom. Then if we go to international, we again take the total international stock market. And this is not showing quite so bullish, but again, it's still coming in the middle. We're still seeing this nice uptick here. We're seeing that correspond to the bullish trend down here. We're still seeing a lot of green dots for a green tilting bullish swing. But we do have a couple of reds down at the bottom. We talked about China a few weeks ago. China is bringing up the rear, so to speak, and then Latin America is just above that. Both of them are showing bearish on trends and swing, whereas the rest of the international markets are showing positive or bullish on both the trend and the swing, everything from here on up. And then finally, we take a look at the bond market. Bonds, with interest rates going up, that's tougher for bonds. Bonds work like a teeter-totter. As interest rates go up, the underlying value of the bond goes down. As interest rates go down, the underlying value of the bond goes up. So with interest rates having increased, that's made it a little tougher. But as you can see, we're still showing bullish in most of the areas. And again, we got the total Vanguard bond market across here. So kind of flat for the year. But it's been it ran up here just prior to the last month or two. We are still seeing down here in the lower right, we're seeing a bullish trend. And we were seeing, however, more bear taking place, these red dots on the swing. But just as of the last few days, it has started to peak back up here. Now, at the top of the list, we've got munis and high yield corporate, as well as intermediate and short-term corporate up here. And then down at the bottom, we've got international bonds coming in in dead last, and just above that is the treasury bonds. So they're kind of down again, still showing mostly green, but down in that bottom half, kind of bringing down the overall bond market, whereas corporates and munis are kind of lifting up the overall bond market. So it's very interesting to watch all this because it's always moving. Every day these numbers change. We take a look at it a couple times a month for you here, but more importantly is to identify where are the trends, what are we seeing there. But as you can see on a chart like this is why earlier when I was mentioning about risk management, why I like to see things with risk management, because when you get these downturns, sometimes you want your money to change and to move inside of that portfolio. Now, again, in the long run, though, it's been going up. And if you give the market long enough periods of time, passive investing does work because the market does tend to always prevail. In the meantime, in the shorter terms, that's where you get into the discussion and the debate, which we started our conversation with today in terms of active versus passive. And then I'll throw in the mix, consider risk management. Hope that was helpful. We'll talk again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.